for people who don't know Sherwood, he has been a leader in the crowdfunding space in terms of a thought leader for years. I originally met him in a Miami event that we ran, maybe it was 4 or 5 years ago. And, I think there's been a tremendous growth in crowdfunding capability in the US, and people are recognizing there's more platforms. I don't know about crowd lending. Maybe you can discuss that also, because crowd lenders seem to be big feeders into Jerry's fund. So Sharon, why don't you kick off, introduce yourself, who you are, what you do, what does crowdfunding, where has it been? What does it look like for 2021? To me, the fact that, they've raised kind of the ceiling to $5 million on what you can raise for a venture is really significant. It really hits a lot of people who go to, seed stage VCs. Maybe they'll be looking at crowdfunding instead. So Sharon, introduce yourself and let's go from there.
Okay, great. Everyone, it is great to be with you. My name is Sherwood Neese. I am going to share this presentation I put together for you, and let me click here, and okay, hopefully you can see that. So again, my name is Sherwood Neese. Today I'm going to talk to you about securities-based crowdfunding, this whole emerging online investment industry that's only, it's nascent really. It's only been around for a few years now, but we're already starting to see attractive yields. And based on the fact that there's been over 800,000 investors that have jumped in those 4 years, I can show you that there's definitely interest from an investor perspective in the space. So as Marty had pointed out, my background's as an entrepreneur. I started on Wall Street, went to Silicon Valley, started my own healthcare technology company, sold that, became an angel investor, created a VC fund to invest in this crowdfunding ecosystem. Like Marty had mentioned, I had written the framework for regulation crowdfunding, so I got to attend the bill signing ceremony at the White House. I've testified in front of the US House and Senate panel hearings about online finance and crowdfunding, worked for the World Bank and the State Department in 43 countries around the world now, helping to help governments and regulators understand how to create policy and regulation to implement this. Built a database that is now used by Bloomberg. So if you have a Bloomberg terminal, it's this whole data set that I'm going to be talking about is in their alternative data set. I wrote a book right there on securities-based crowdfunding. So I know a lot about it. Like I just mentioned, all the data in this presentation is part of the Bloomberg alternative data database. So everything that you're going to hear me talk about here comes actually from that data feed that we bring over to them. We pull in data from about 50 different platforms every night. We clean, we normalize, and then we transmit that over to Bloomberg by noon every day, 365 days a year. So we have a pulse on what's happening in this online investment industry. The industry itself, like I said, is only a few years old. It really kicked off in 2012 with the Jobs Act, but a lot of the provisions of it didn't go into effect right away. The first one with Title III, which allows for online accredited investors to come into the marketplace and has no caps on it, went into effect in 2014. The sweet spot for this is still the same as it was before. You've got these high growth Silicon Valley type of companies that are seeking capital. Title III is called regulation crowdfunding, which is where I have a specialty. Like Marty said, the SEC is increasing the cap from 1 million to 5 million. It allows both retail and accredited investors to participate. The sweet spot for this we're seeing is all types of SMEs in industries across the board that have engaged customers, which is a unique thing because I'm going to talk about that. These businesses are turning to their customers for investment, and these investors now have a stake in the outcome of the business and really are driving sales to these opportunities. One of the things that I want to point out to you is there's been zero fraud in this space. The SEC did a report on the first 3 years of it. So it's great to see that people that talked about this would be boiler room, they'd be full of fraud. There's been zero fraud. It's actually incredibly hard to commit fraud in this space because you have to pull the wool over so many eyes. The last one, which is the biggest one, is Regulation A+. It was called Title IV. It went to effect in 2015. The big opportunity there really is Tier 2, which was 50 million. It's moving up to 75 million in about February. And the sweet spot for this is funds, real estate investments, and the like. Again, I'm going to focus on a segment that I don't think many of you hear about often, which is, what's happening on Main Street USA. I just want to point out that if you look at those three exemptions, 506C, Reg CF, and Reg A, last year in 2019, they added up to $67 billion of investment. So there's a lot of money going to the space, which represents a lot of opportunity. If we just look at the Reg CF point, the data set's growing dramatically. We cover 3,000 companies and offerings right now. Right now, there's about 100 new offerings a month. So we're currently tracking 566 active companies that are raising money online. They're doing this on about 50 different investment platforms. Like I said, we pull all that data in. What's fascinating about this is you would think this would just be, restaurants or small businesses, but in fact, when you look at the industry by NASIC code, we have over 450 different industries represented. So there's the ability to diversify across a broad industry data set here. Within the United States alone, we've got 1,000 cities that are represented from companies that have been funded. And what's interesting is people often think about, the type of companies that are going to be using this are going to be your riskiest, the smallest. And I can't disagree with that, but what I can tell you is it's changing. And so in the beginning, I would say about 60% of the companies, were startups. And now, actually, it's more than that. It was like 80%. Now it's falling down, and we can see that the companies that are more sophisticated and have been around longer, about 40% of them. And I think as we shift to this 5 million cap, where more medium-sized businesses that need in excess of $1 million want to raise money, we're going to see more older businesses, which means less risk because they're more established, coming on and raising money from their customers. These companies, these 3,000 companies, have about $1.2 billion in revenues. So you can see that's an economic multiplier at a very local level around the United States. What's been fascinating about this is because companies that raise money online through this legislation have to file ongoing disclosures with the SEC and make it available for investors, and we pull all that data in, we can see that companies that have been successful with these Reg CF offerings have had on average a 23% year-over-year growth in revenue. So something's happening. Maybe this was the capital that they needed to grow. Maybe it was these investors that are actually doing what they say, which is out there marketing for the business and helping drive sales into the businesses itself. But for one reason or another, it's turning out to be beneficial for the businesses and for the investors as well. Just in Reg CF alone, there's been about $883 million in investments, and there's been about 900,000 investors that have invested in this space. So there's a broad appetite for people that are interested in this. All I wanted to point out on this slide, because we did a whole presentation for Bloomberg and their team and people that subscribe to it, is the data set is increasing exponentially. Right now we've got about 3,000, but because there's about 100 coming on, we're probably going to double that data size in about 2 years. If you're familiar with algorithms and what this means for feeding that, it just improves the outcomes of the algorithms, because if you're looking at a macro and a micro level data sample, and you're looking at the Dow Jones or what's happening with public companies, that's a small subset of what's happening. When you add in our data, it actually reduces the bands of errors that you can have in your outcomes. So it was interesting to see that. Our data set, I'm not going to go into it, but this slide just goes to, I just want to show you that there's 125 different data points. We cover things that aren't in disclosures to the SEC. So we research the industries, the valuations, and then we actually find out the investor interest by looking at daily investments that go on. And I think that's the really important thing, because you want to know where capital is going on a daily basis. I want to do 2 case studies here because I think it'll be helpful for you to understand what types of businesses are using this, or how economic things like COVID are impacting online fundraising. So the first case study that I want to point out is with our debt offerings. So with regulation crowdfunding, you can use any type of security, but we do find that you've got Main Street type of businesses that are cash flowing operations, retail, restaurants. They're going to be using debt type of instruments. If you've got a company with an exit type of strategy, the logic seems to be there, and those companies are using equity instruments to raise money from the crowd with the hope of a sale, a merger, or an IPO down the road. So why are these small businesses using online finance and debt offerings to raise money? Well, the reality is banks are not lending. If you know anything about what happened with the Fed and these Main Street lending programs, they were a miserable failure. They had $600 billion. They only deployed $4 billion through 420 loans. And so if you're a small business, you're just not getting money from any of these banks right now because they're looking at through the lens of COVID and credit's tight and their fees are going to be high. So they're turning to these platforms, and we're seeing, and I'm going to show you how it's increasing over time. But what I did is I took a look at 100 different debt deals that are happening, ones that have hit a minimum funding target, ones that have a minimum number of investors. So we could see that there was a group of people that were in first that clearly saw something about this deal. And then I ran some analysis on it. And what I found is the average yield on these 100 different investments was about 11.22%. Which is quite attractive when you consider what you're getting on your money in the bank or elsewhere. It's not happening. I'm not saying, no one's ever saying put all your money in this basket. I'm just saying if you want to consider diversification, there are attractive yields to be found in this space. The median term for these types of offerings is about 48 months. And so you get immediate ROI and you know that it's beneficial for them and for you. What I think is interesting and we're working on right now is the ability to create a syndicate that invests along inside these deals that are happening. So there's a way in which to follow the crowd now by investing in what they seem to be appealing. And what the beauty about this is these are local businesses that are raising money predominantly from local investors. And so these local investors are actually want to make sure that these businesses stick around. So they're providing a level of diligence that we're not seeing in typical type of VC type of deals where a VC might be halfway across the country from their portfolio company or only invest in the portfolio companies that are right around them. Here you actually have this group of people that are highly engaged in the outcome of that business and are helping it survive pandemics like this. Okay, so the case study number 2 that I wanted to talk about really focuses in on how has COVID had an impact on the ability for these small businesses to raise money. What I think is fascinating about this is it's been like an inverse relationship. So COVID hit and we thought, the markets would shut down. We've seen Wall Street surge. The reality is we've seen the amount of investments going into these private offerings surge as well. So if you look at the circle down here, this is, COVID hit in, February really, and then investor sentiment sort of fell off because everyone was wondering what was going to happen. We didn't know what was going to happen with the public markets as well. Once there was a little bit of stability and people were sort of confident that the markets had a take on what was going to happen and took in all the negative, we're starting to see this surge taking place. And it is a surge that we haven't seen before, where on average, I would say we've got about $10 million a week flowing into these startups and small businesses on these online investment platforms. So, while, like I said, there's been about $880 million over the past really 4 years since this got going, I believe in the next 12 months, there will be $500 million that flow into this segment of the markets because investors clearly want to support these businesses in their communities, and they're doing it in a way that is attractive for them. The other thing that I wanted to point out is, so where is this opportunity taking place? So if we look at the industries that have seen the highest growth, we've got software application, which has seen a 470% increase in the average, in the number of average monthly offerings. Staffing and outsourcing has seen a 320% increase. Internet connection and information, specialty finance, entertainment, personal services, biotechnology, science and technical instruments, and wineries and distilleries. I wanted to read through the list for a specific reason. If you look at this list of industries that have been what I would say positively impacted about this crisis, there's something in common, which is we're all living at home. We have all adjusted to the way we are doing business and our children are learning. These industries represent companies that are benefiting from this crisis and are coming out with new software applications to help kids with learning, are helping companies figure out staffing and outsourcing needs amid the crisis. And so it's fascinating to see that where there is, where we've got problems, you've got people and entrepreneurs that are coming up with solutions, and the crowd is coming in and backing it with capital. Funny enough, wineries and distilleries, maybe because we're at home again and we're trying to cope with this pandemic, turns out to be seeing a tremendous increase in these offerings as well. What I want to point out about this slide as well too is, again, the diverse representation of industries. So you might think that, software application, of course, this would make sense because, it's Silicon Valley and investors find it as an attractive investment opportunity. But entertainment's a sweet spot, mainly for investors, and it's mainly for an LA type of area. This diversifies the ability for investors to invest all across the United States, and you don't have to be in LA. So I think where you see all these industries, it's because these companies might not fit the sweet spot for a VC or a private equity group, but clearly they fit the sweet spot for people that know them and customers and investors that believe in them. And so I think it was interesting to look at it that way. What I want to point out in this slide is, we used to be tied up into these private company investments, and there was really limited ability for us to have liquidity. Yes, there was secondary market, which was great if you had the securities, you wanted to buy the securities, but this is all changing right now. So if you weren't familiar with what is happening with these exchanges called alternative trading systems in the United States, they're now coming more into the marketplace. And so this is how I envision the pathway to liquidity for both investors like you, but even retail investors that are getting into these private company offerings. You've got these primary offerings that are taking place under Reg CF or Reg A for exempt and unregistered securities that can be either immediately freely transferable or transferable after a short holding period. Provided that companies provide these ongoing disclosures so investors know year after year what's happening with it, much like a 10K or a 10Q. And there's companies like Guard, and what you see on the right-hand side of the screen there is a Guard report, which is really a 2-page summary, very much like a 10K for a company, which provides all the detail about a company, its operations, and its financials from its audits for the 2 most recent years. If that is provided and published in a national securities manual, then that company can qualify for what's known as an exemption, a manual exemption from state registration. So once they have that, they can now list their securities on these alternative trading systems. And so companies now with investors that say, hey, I need some liquidity for my investment, will be going to these ATSs. The companies will be providing ongoing disclosures with a hyperlink so you can actually get these reports. Supply and demand is going to determine whether or not there's a market for these securities. But in doing so, you're going to have better pricing because the supply and demand is going to tell you what investors truly think these securities are worth when they're trading on these exchanges. And so then what happens? Well, you can get liquidity that way. You can buy some more securities in some of the hottest new technology startups that will be coming to space. But these companies are going to also be looking for follow-on capital. So you've got these, the SPAC market is incredibly hot. I'm sure you're hearing about that today. And it's an innovative way for some of these Reg A offerings, I would say, to actually do an IPO without having to go through the bureaucracy and have to deal with an investment bank that the industry's shrunk dramatically for them. And so I think you're going to see better investment opportunities, better liquidity opportunities for you as investors and retail investors as well. I will end with this, which is this type of investment is an amazing way if you're interested in providing education through a family office to your smaller investors, your kids, because it teaches them to invest online, which is the way we live, using technology, which is the way these kids communicate. They can learn about investing by literally trying it on these platforms in small amounts. We're not talking, millions of dollars. They can invest as little as 500 and learn a lot about it, which means lower risk, but it's amazing, great life lessons by investing. And you can actually come up with your own core values in terms of how do we want to teach this through diversification investing? Do you want to invest in based on gender, race, or demographics across the country?
Sherwood, just real quick. So are you actually sponsoring your own platform these days?
No. So we, when we got this going and we were lobbying Washington, D.C., they said we wouldn't get behind you if you were going to build a platform. And jokingly, we said, but isn't that how Washington works? They corrected us and said no. So we gave them the idea of building a platform. But we have become investors through in about 12 different platforms in the space through our fund. So we are benefiting. One of them just had an exit, and we saw a 15.3x return on that one. So there's opportunity to invest in the infrastructure of the space, invest in the underlying companies, and create syndicates like I was talking about to invest in industry.
And do those platforms operate like an angel list or something like that, where you create the syndicate, you can rank a syndicate, et cetera?
Exactly, right. So right now we are actually doing that. We're researching and doing it, planning on doing that on AngelList.
I'm sorry, I got a couple more questions. Unfortunately, Sherwood, what's happened is that we do not have enough time for all the questions you're getting asked, but I have another one here. What's a typical duration or liquidity, ease of exit of one of these deals?
So the debt ones, like I mentioned, have about 48-month term. If you're looking at the equity type deals, it's no different than your regular type of equity deals. You're looking at a 5 to 7 year time horizon. It all depends on the exit strategy of the company. But that's why I put that last slide in there is if companies want to stay private longer, there is the ability for liquidity on these ATSs after literally about a 1 year or immediately if it's a Reg A offering, but with a Reg CF after a 1 year holding period.
Right. And I know you talked about Reg A little bit. Reg A has been a little bit perilous for some, but maybe it's gotten adjusted some, because I think the old Reg A requirements, or there was a limitation of $50 million you could raise, and maybe now it's 80 or more?
75 million, yes.
75, okay. Because I think a lot of people who did Reg A in the first generation, they said, I raised too little money, I've got to go back to the market, I've got to raise more capital, et cetera. So where do you see that going, the whole Reg A business?
It's just going to continue to grow. So I think the harmonization that the SEC just went through and increasing the caps really allows buckets to form for different size entities. And I think the Reg A is going to be a great vehicle for a lot of these smaller funds. You can do Fund 1, Fund 2, Fund 3, 75 million at a pop. And then as soon as it gets sophisticated enough, you can take it into a different realm and a different exemption. But I think we've created an on-ramp for both companies and funds to go. And to your point earlier, by increasing the cap of Reg CF from 1 million to 5 million, literally any startup that is looking for a seed round would fall into that bucket now. So you don't necessarily have to know a VC in order to raise the money that you need to get your startup going. You can actually use this legislation now and friends and family to get it done.
And my last question is, do you think this is going to kind of follow the trajectory of the existing lending platforms where those became marketplaces? Originally they played really big with the family offices because they had big returns, right? And then institutions poured in and returns flattened out. Do you think that's going to happen as well in this? And I'm sorry, I have too many questions. This is probably my last one, because I have questions about risk management too. But keep on going.
Yes, the words I keep on saying 2021 is going to be the year of the crowd. People have not, even though this is about 5 years old, nobody knows about this industry. It's really emerged and the traction is starting to build right now. And so I think we're going to have more companies, particularly with the crisis that we're in right now, that can't turn to banks coming online. That means that there's a need for that capital. And I think this is where the institutional side of it comes into play. And they'll be backing these businesses, but they're going to be looking at it from a different lens, like how many investors are in it? What's the amount of capital that they need? Who are these entrepreneurs that are doing it? So, yeah.
I think the key is going to be risk management, analytics. It's going to institutionalizing it, as you pointed out. And we'd love to have you back again. This is great stuff. And so again, let me just give you a round of applause. Thank you so much. Thanks, and please publish your information. People are asking for your contact information. So if you go to the chat and publish your information, that would be great. And if you can just send me a copy of this presentation at some point, I'd like to make it available to the audience.
Yeah, definitely. Okay.
Perfect.